Hello and welcome to Investing from the Scratch. Everything I wish I knew when I started investing. This video is dedicated to all of those who are thinking about investing but have no clue how to begin. And I'm here to help giving you some basic information about it. Today we are going to discuss the haves, what an investor must have in order to start investing and continue investing successfully. This video is a follow-up to the part 1, where we discussed the personality and character traits that, in my opinion, are making a person a potentially good investor. An obvious disclaimer before we start: this video is for educational purpose only. It is not financial advice in any form or extent, so don't use it as such. What I'm trying is just to share what I learned. I'm not trying to teach you anything. I am not qualified to do so. So I'm just telling you what I saw and what I learned on my way to become a successful investor as I am today. But that's it. There is no intention of teaching you something. It's just sharing my opinion. About me, I'm a retail investor. I have been active as investor, trader for more than 25 years. I have been making a lot of mistakes in my career, and I learned a lot from those mistakes. I also survived a number of rather nasty periods of time without getting killed in the process. So I saw the financial crisis, I saw the dot-com bubble, and many other minor accidents on the way. Again, I learned a lot of things from those times, and I would like to share them with you during this video. Okay, first of all, I would like to respond to comments I received on the previous video. I think I will make an habit of this because I prefer just to speak and to dialogue with you instead of just writing stuff in the comment section on the video. Thank you very much, first of all, for sharing with you your comments, your opinions on the first one, on part 1. And the comment was about the fact that investing is risky, but so are all other business activities. It is completely right, and I totally agree with you. With the only difference is that investing is extremely easy to start, whereby other forms of businesses, like opening a shop, for instance, or become a contractor or something like that, are much more difficult in comparison to starting investing. A person can literally start an investing activity within a few days. Open a broker account, send them some money, and you're basically done. That's everything it takes. And that invites a lot of people who are completely unaware of how investing actually works into basically betting their money in a way that A is wrong and B is dangerous. And indeed, the investing activity is famous for having an extremely high percentage of failures. In part 1, we saw that 70 to 80% of people investing their money actually lose money. And that is not typical of any other form of business. So that's also the reason why I started these videos, because I know there are a lot of people who are thinking about investing. They don't have a clue, and they basically don't want to risk it because of the fact they respect their lack of knowledge and they don't even try. And what I'm trying to do with this video is exactly that, is try to prepare these people, to give them some very, very basic ideas and views about what is investing, so that they can take an informed decision if they want to get there or they prefer to stay out of the investing activity, the investing business. The haves that a person needs to become an investor depends greatly on the kind of investor you plan to become. So you can become a passive investor or an active investor. A passive investor is somebody who, for instance, decides to dedicate a certain percentage of their regular job salary to invest in something that doesn't require much care. For instance, an index fund. So every salary, a small portion of it is sent to a broker to buy a certain amount of an index fund, and from that moment on, this person just waits and doesn't do much about it. An active investor is different because he normally would buy and sell regularly, something that a passive investor wouldn't normally do. And within the active investing world, there are certain subsets of possibilities. So you have the fundamental investors, active investors, who are looking, for instance, at the balance sheet and the cash flow and the P&L of companies in order to make decisions. Then there are the technical investors who are either operating intraday, so basically they make many different transactions during the day, and they take care of closing those transactions by the end of the day. They're called day traders. And those technical investors who are not willing or not interested in closing their positions every day, they are perfectly fine in leaving them open for an extensive period of time if needed. But these two different approaches require completely different halves. And we will see now what are the differences between the two. Let's start with the most important half. It's obvious, but it is money. It takes money to make money. Without any money, you cannot start investing. Simple as that. Now, there are a lot of discussions around, and there have been a lot of discussions forever about what is the minimum amount of money a person needs to have in order to start an investing activity. Discussion is a bit silly because there are no minimums that are universally accepted by everybody. You can start investing $1 or $100. It doesn't really matter. What matters is what kind of money you need to open and to keep open an investing account or a trading account. Your broker, the broker is the company that actually is between you as a retail investor and the stock market. They buy and sell assets for you on your instructions, okay? So the broker that decides what is the minimum amount of money you need to have on their account in order to operate. So you can have a broker which requires a minimum amount of money like $100, another broker which requires $1,000 or more. So that's the minimum requirement. It is dependent on the broker you choose to use. There are, however, a few important considerations to be made in terms of minimum money that a person requires when we are talking about a risk. So if you have $100 and you invest in one company, if that company goes bust, you lose $100. When you have $1,000, you can afford maybe to invest in 2, 3, 4 different companies. Now the chance that all these companies goes bust is smaller than just one. A small amount of money to invest leads people to diversify their investment as little as possible, because they don't have the means to diversify. They don't have the means to select different assets to invest in, which increase their risk, okay? The other thing that is important to discuss very briefly is the fact that whatever money you decide to invest, it must be money that you can lose tomorrow without consequences. So we are talking about money which is considered to be disposable income, or money you don't know what to do with. An easy way to understand the difference between money that you can invest with and money you cannot invest with is, imagine you have $100. Can you put that money in a saving account and basically forget about it for an extensive period of time? If so, that money, instead of being put into an investing account, in a saving account, can be used for investing. If the $100 are needed next week or next month to buy food or to pay the rent, that's money you cannot and should not decide to invest. Because remember, money that you save can normally be taken back more or less as they were if you need them. When you invest money, because of the fluctuations in the market, because of events that can and probably will take place, those $100 can be easily $50 in 1 month's time. And if that happens, and the money is needed to do something which costs $100, you have an issue, and a serious issue too. So remember, money for investing is not money you need in the short period of time. And you must be able to lose all that money tomorrow if needed without any serious consequences. This is, I think, a very sound rule, but unfortunately a lot of people do not follow it. Not only do not follow it, but they do an additional mistake. They borrow money to invest. And what happens with that is that they amplify the amount of risk they take when they put money to work buying an asset on the stock market. Because if things are going differently than what they thought, not only they are losing money on their investing activity, but they have also the additional issue of owning money to somebody else, and that money must come in. So it's a double loss, if you want. And unfortunately, the investing market is full of people who are extremely pleased to loan you money because they make a profit out of you. And we are talking about banks, we are talking about brokers, we are talking a lot of parties that are interested in lending you money very easily too, but they know very well that if something goes wrong with you and with your investing activity, they will make a profit. It's not for nothing. On top of that, consider the interest that you're going to pay on a loan if you decide to take such a loan for investing. It's a personal loan. So it costs you a lot of money just to have it. And you still have the problem of repaying it one day. So be extremely careful with that one. A lot of people lose fortunes in very, very short period of time, not only because they are not prepared to start an investing career, but also and especially because they are using borrowed money. It's called leverage. It has many names, but basically it's borrowed money. And if you use that, you're really taking a risk that you shouldn't be taking, especially when you're at the beginning. The second thing you need when you decide to start an investing career is time, because whatever kind of investing career requires at least a little bit of time. And there are certain gradations. You can divide the amount of time you need in 3 basic categories. Passive investing, active investing, and intraday active investing. What's the difference between these 3 broad categories? The difference is that when you are when you're thinking about becoming a passive investor, you basically decide to dedicate a portion of your salary to buy an index fund and basically forget about it. You buy something regularly, you don't have any plan to sell it in the short term anyway, and you just wait. You don't need to monitor the stock market, you don't need to read a lot about it, you just do it regularly, like every month or every period in which you have, every moment in which you have money to invest. You buy only. That's more or less how it works. And once you set up this activity, the rest is simply to do always the same thing, which requires a few seconds, and nothing else. So from that perspective, the passive investor requires the minimum amount of time in the three main categories. Active investors require to have a more time to follow their investing, because the active investor buys and sells, and it is not consistent like every month, the 27th of the month, for instance, I receive my salary, I put away 10% of it. No, it's every day, if a person so wish, of course. But because of the fact that the active investor buys and sells, the amount of time that this kind of person must dedicate to the investing activity is larger than just buying something once a month. And that is not really depending on the kind of approach you use. You can be a fundamental investor. Fundamental investors who need to read the financial documents of companies, for instance, or to understand the macroeconomics of the situation as it is today, or whatever other information a person finds important, that requires some time. And that applies as well to the technical trader, to some technical traders. So if you're looking at charts, and if you're using charts that are based on a time frame which is 1 day and beyond, 1 day, 1 week, 1 month, then you can dedicate the amount of time you wish to follow your investing, but there will be some follow-up. You will need to monitor how your investment activity is doing on the basis of charts this time. The investing activity that is not compatible with anything else is intraday trading. And intraday trading means that a person opens and closes all his positions during the same day. Intraday traders are using very small time frames, 1 minute, 5 minutes, 15 minutes sometimes, or even smaller, goes in seconds. Now, if you decide to do that, you cannot have a regular job, because these two are not gelling together at all. So the amount of time that an intraday trader needs to have available is 100%. During stock market hours, if this person decides to trade, he will not be able to do much more than that. In general terms, when you start looking at how much time does it take to invest, you have to decide what kind of investing activity you prefer to do. But remember, there are certain approaches to investing, intraday trading for instance, which are incompatible with anything else. The third thing you need to have is knowledge. You have to know something in the beginning in order to start an investing career. General rule is always the same. Know what you do before you do it. If you don't know, don't do it. Just as simple as that. But let's start with a passive investor. Passive investor, as we discussed before, does not much. He just takes a little bit of money and puts it in, for instance, an index fund or something that he doesn't really need to follow in any way, shape, or form, and basically forgets about it. There is not much knowledge involved in that kind of activity. When we're talking about fundamental trading instead, so buying and selling on the base of your opinion on the health of a company, reading the financial statements and so on, well, this person will need to accumulate a relevant amount of knowledge. The fundamental side of investing is full of accountancy terms. It's full of ratios and other. It has its own vocabulary, which is quite complex in a way. So the amount of knowledge involved in doing that form of activity, that form of investing, is quite extensive. The technical day trading will also need to have a lot of knowledge, but that knowledge is then more focused on reading charts. And reading charts is also a science. For some others is an art, doesn't really matter. But there is an extensive amount of knowledge needed to read a chart and to take decisions based on reading a chart. That's knowledge, and it's quite a lot. The technical day trader, intraday trader, so the guys opening and closing positions the same day, needs to have probably even more knowledge about how to operate their investing activity, simply because the time they have available is much shorter. So they need to react to things very, very quickly. And in order to do that, they have to learn additional instruments for them to be able to be successful. So, as you can see already, the amount of time, knowledge, and possibly even money depends very much on what kind of investing activity are you thinking about. Let's remain a second on the subject of knowledge, and let's explore a few things that most investors will need anyway. The first one, you must remember, when you talk about money, you're talking about taxes. In most of the cases, an investing activity will have an impact on your tax situation. And your tax situation depends on the laws that are applicable to the country you're living in. So I'm not going to help you with that one specifically, but just remember, in the moment you make, for instance, money out of your investing career, it's pretty possible the taxman will want a part of those. So if you don't know the rules applicable to these situations, you are at risk of getting very nasty surprises at a certain moment in the future. Then we're talking about fees and costs. Investing is a costly activity. Nothing is for free in this world, but investing means that you have to pay for fees and cost in various ways. We can talk about, for instance, a maintenance amount of money just to keep your account alive. We are talking about the spread between, for instance, buying and selling a certain asset. We can talk about the cost involved in receiving a dividend sometimes. There are a number of different ways in which the investing activity, even if it is successful, will cost you some money just to do it. If you are unaware of the costs involved in the investing activity you prefer, then it's pretty possible you're going to lose money even when you are successful. And I give you an example. Suppose you decide to buy 100 shares of something when they are $1 each. It is 100 shares you buy. When the shares are going to $2, you sell them and you get now $200, $100 advantage, $100 profit. But if the costs involved in selling and buying those assets are above $100, you're losing money. And that is not so strange as it sounds, because when you put all together the various ways that investing costs you money, it is not uncommon to find out that certain level of investing is actually not going to deliver any profit. And that goes back also to the minimum amount of money you require. If the amount of money is too small, then the fees and costs that are often calculated as a percentage, but often also a lump sum, they will eat away most of the profits you can make. So don't forget about this particular aspect and be very careful. This is particularly important when you choose a broker. Choosing the right broker means also choosing a broker which is cheap, and it is clear in what kind of fees and costs they will calculate for you to open an account and to keep it. Then you have to be very realistic about your expected returns. You have to have a knowledge of what you can expect. And the reason is a lot of people think that they can become rich or they can double their money in 1 month, 2 months, 1 year, 2 years maybe, and they rely on that knowledge in order to make some decisions. For instance, I will buy a new car this year because I know I will double my money anyway, so who cares? The car is already paid. It doesn't work like that. You have to have a knowledge about what you can reasonably expect to receive in case you are successful from your investing. And just to give you a very basic idea, the Standard & Poor's 500 delivers historically, on average, something like 9–10% per year, give or take, okay? When you're talking about making 50% of your money 1 year or even more, you are really outside of what represents a realistic expectation. You might be extremely good and getting there, but do not count on it. That's the bottom line. Be realistic in what you can expect in terms of profit. You have to have a very specific knowledge about what kind of risk you take when you start an investing career. And the risk in question has multiple phases. So for instance, we discussed it before, there is always a risk to lose all your investment money. It doesn't almost matters what kind of investment you do. There are certain investments that are extremely safe, but they are also making no profit. Actually, they mostly lose money. But when you're talking about investing in shares or in options or in currency or whatever else, there are risks involved, and you must be very aware about the level of risk you are taking in selecting the kind of investing you are doing and the assets you decide to invest in. We will go back to the aspect of risk a number of times in future videos, because investing and risk, as we said, I think the first in part 1, are almost synonymous. Okay, investing equal risk. So risk will come back again and again during the future videos, but for the moment, know what kind of risk you are going to take before you take them. And then you must have some knowledge about the rules of the game depending on the kind of investment you're making. For instance, if you're a passive investor and you decide to invest in a 401k in the US, it's called like that. Can you take your money out of your investing account without costs or without penalties? Can you do it before a certain period of time is expired? If you're an active trader, can you just call your broker and say, send me my money and expect to receive it tomorrow? Or many other situations of this kind where you need to know what are the rules applicable to your situation in order to avoid making the mistake of relying on something that is maybe not there when you need it. The fourth thing you need to have is stability and peace of mind, particularly for active investors, but even passive investors are subject to this general rule. Now, investing is a stressful activity, especially when things are going south, especially when things are going wrong. Even people who are investing in an index fund in order to, for instance, build a pension, when the market tanks 20%, I can guarantee you they will become nervous. And when we are talking about active investors who are actually buying and selling continuously, those kind of events will take a toll on your peace of mind, definitely. So you need that, and you need that consistently. If you try to become an investor and your life is a mess for some reason, you're subject to high level of stress outside of investing career, the investing activity that you are going to perform will only increase the amount of stress you are under. So be very wary of that factor. It doesn't really matter what investing you do. If you are going to be an intraday trader, I can guarantee you your stress levels will skyrocket. And that's the most stressful form of investing there is. But everybody else must be prepared to accept an increased amount of stress, particularly when things are going in a way they didn't expect or they didn't count on. You will need to have, if you have a family, you will need them to support you in your plan to invest. And the reason for that is very simple. If you have a salary of $2,000 and you decide to put 10% of it, or $200, away for investing, those $200 will not become a PlayStation for the kids, and will not become something nice for your spouse. So if they don't support you in the fact that you are actually dedicating a part of your salary to do something else than for them, or not directly anyway, you will have a problem, because that will create a lot of tension, and that will impact on your stability and peace of mind to a very large extent. And I saw that happening a lot. Investors, people who are on the stock market, they are trying to make money, they get a lot of questions from their family about what are you doing, why you're doing, and why can't we just use this money for going on holiday and this kind of stuff. So be prepared for that and be able to manage it. If a family is not supportive, you will have a trouble of some kind. Then you need to have consistency. And consistency means that once you establish a system, an approach to investing, you are better to keep that approach consistent, always the same. A lot of young investors, beginner investors, are extremely inconsistent. They do one thing today, another thing tomorrow, they try a third thing the day after tomorrow, and it always fails. And it always fails most of the time because without consistency, they don't give the time needed to their approach to work out. That also has to do with the time discussion we had before. Certain things are excellent ideas, provided you give it the time to become excellent ideas. But because of the time sometimes a bit long, people start to become impatient. That goes back to part one. Being impatient is a very bad trait. And they start to change their plan continuously. And they fail continuously, because no plan is good if it has no time to come out. When investing, you will also need to have and keep a certain perspective on things. Okay, a lot of people lose the perspective of having, say, I don't know, $10,000 invested, because again, when the market goes in an unexpected direction, maybe suddenly, they panic. They see this $10,000 becoming $5,000 in a few hours or in a few minutes even, and they panic. Having the perspective of looking at time in a way that makes sense. Today is going down, tomorrow will go up again, there will be better opportunities another time. Just keeping a broad mind about what is the investing activity. It's not all your life. It's only a part of your life, and it has a specific purpose. But do not forget the rest of your life. A lot of investors, particularly intraday traders, forget most of the rest of the life they need to be busy with. To have a job, to have a family, friends, time for yourself, and so on and so on and so on. Keeping your perspective open is extremely important. The last thing you need to have on this particular subject is simplicity. You need to keep it as simple as you possibly can, within the limits of your knowledge, of your experience, within the limits of the trading approach you decided to use. Keep it as simple as possible. And the reason why I'm telling you that is that most investors who are actually become unsuccessful, so they fail, they lose their money, are typically complicating matters to an extent which is unbelievable. From fundamental traders to active traders to intraday traders, all of them makes the same mistake. They overcomplicate matters, where in fact 90% of the result you want to achieve is based on the 10% of simple things you need to do or not to do. One of the two, depends. We will talk about it in future videos. But for the moment, keeping it simple as possible is essential, not only to become a successful trader, but also to keep the stability and peace of mind you need in your life in general. Overcomplicated matter will increase your level of stress and will reduce the amount of success you can expect to receive. You need to have precision and control for investing. This is particularly true for active investors, although a little bit of precision and control is applicable also to passive investors, but active investors in particular. You need to develop a psychotic mindset based on counting, 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 checking, checking, checking. A lot of counting and a lot of checking. And the reason is very simple. If you don't count what you have, if you don't count what you want to have, and if you don't count how much you can make or lose when you do something, you immediately lose control. And when you lose control of your investing activity, you are basically inviting disaster on your door. Without control, you cannot possibly invest successfully. You must be extremely lucky, but it's not going to happen. Trust me on that one. So counting. Checking means that before you do something, you make absolutely sure it is correct. There is no room for mistakes in investing, particularly on the active side of investing. A single zero, more than what it should be, can put you in a disastrous situation. I'll give you an example, a very simple one. Imagine you have $1,000 of your account and you want to invest those $1,000 in shares of a certain company. What you do, you say, okay, I want to buy shares of this company for $1,000. Instead, 3 zeros, you insert 4 zeros. Now you have a $10,000 trade, $10,000 trade. In the moment you click enter and the trade is executed, you have a $9,000 debt that you need to repay. So if those assets that you just bought go down by just a few percentage points, you have an enormous headache in front of you. And it is just 1 zero mistake, one number. That's everything it takes. There is really no room for mistakes in investing at every single point in time. So if you are not precise and you don't keep control of what you're doing, particularly on the active side, it's just a question of time before you get yourself in a sea of troubles. Very, very difficult to get out. It should be clear by now that the haves that are needed for passive investors versus active investors are quite different. So passive investors need, in general, very little time, limited amount of knowledge, and probably they are going to incur less costs than other forms of investing simply because they trade much less than anybody else, for instance, once a month. So from all perspectives, passive investors look better off in terms of probable success on their way forward. The reason why that is not always true is that passive investors are actually subject completely to the force of market movements. Because they don't trade, so they don't sell or they don't shift their investments when the time would indicate, by definition they decided not to trade really. They only buy assets and they keep them for a very long time. When the market goes down 20%, they will go down at least 20% as well, most probably. And the impact of that will stay as long as the market remains depressed, as long as those 20% don't come back and their account doesn't become active again. So really, the passive investor is dependent on very, very long time, possibly very, very long time. The active investor has disadvantages in terms of money, probably needs more money to start than a passive investor simply because having more money potentially decrease the risk of failure from the start. Having more money, for instance, allows a person to diversify his investments. That means that you can buy multiple assets instead of only one. We will go back on that subject in later videos, but for the moment, more money, more time, to study, learn, observe graphs, learn indicators, and all other things that an active investor need to do in order to become active and take informed decisions. A lot of knowledge, and in general, the active investor has a more complicated life. Let's put it this way. The advantage of an active investor, potentially, is that this person will be able to take decisions in order to maximize his profits or minimize his losses. Because by trading, buying and selling different assets at different times, according to different techniques and methodologies, this person has potentially the ability to realize profits even when market conditions are negative or in shorter periods of time. Again, potentially, because there is no clear set rule about who between the two is typically the most successful kind of investors. But one thing to remember is that passive investing is largely dependent on the amount of time the investing activity continues for. So if you are passive investing for 1 year, it's probably not going to work very well. If you're passive investing for 20 years, there are very, very large possibilities you will become successful. For active investors, it's different because the passage of time is not as important as for passive investor. The real difference for active investor is made by the skills of that person in performing his activity in a good way, in a profitable way. Reading charts can be one, reading financial statement can be another, combination of the two can also be. But being active allows this person to move in the direction that this person finds better to do. So passive investing really means entrusting one's money to somebody else and being dependent on how the market is going at any given point in time. So the passive investor is subject to external forces and is completely dependent on external forces. By being passive, this particular kind of investor decided beforehand that he will not try to steer things in a certain direction. He will go with the flow, and he will go by the level of experience and skill set of somebody else. That's his success. The active investor relies on himself, on his own skills and experience and knowledge in order to take informed decisions about what to invest in, when to invest, what to buy, what to sell, if it is time to change direction, and so on and so on and so on. In terms of results, both active and passive investors can achieve absolutely fantastic results, both of them, with the only difference, notional difference, is that passive investor may have to wait a bit longer than active investors in general terms. Simply because when an active investor decides to change strategy, for instance, or decides to change his investment portfolio according to different market circumstances, being active, he is now able to steer things in a certain way, something that the passive investor will not do, has decided not to do. So, time is needed very much for the passive investor, is needed to a lesser extent for the active investor, assuming he has the necessary skill set to perform his activities correctly. The discussion about the different halves needed by different kind of investors is finished. I hope it was useful for you. I learned something or gave you some ideas on what to do next. Becoming a passive or an active investor is really extremely important. So think very carefully about becoming the one or the other. During part one, we discussed the character and personality traits that are needed for most investors, particularly active investors. In part two, this part, we discussed the has needed by the one and the other. So on the basis of these first two videos, I hope you will be able to take an informed decision on what you want to become in the future. And especially if you want to become an investor in the first place. That was the first question in part one, which I tackled. Should you become an investor? Now you know what you need to be, and you know what you need to have. And now you can take a decision, I hope. Next time, I will dedicate some attention to describing the functioning of markets. What are these markets everybody is talking about? Markets are filling the titles of newspapers, are all over the news every day, but what are they? How do they work? Who works in the markets? And why they do certain things in a certain way at a certain moment? How they operate in general. Market structures, market movements, market participants are all very interesting things to know for passive investors as well, are fundamental for active investors. If an active investor doesn't know how the markets work, then it will be very difficult to understand why a certain asset loses money suddenly 20% in a few minutes, or why certain assets are going up in price whereby other assets are going down in price. It all depends by the way markets work in general. Passive investors do not necessarily need to have a knowledge about the way markets are structured and the way markets are working, but it could be very interesting for them to have a view on them, because even when they decide to invest passively, understanding how markets work help understanding also why their investments are going up or down or simply nowhere. So fundamental for active traders, advised for passive traders as well. We are at the end of the video, we are at the end of the presentation. I hope it was interesting, possibly useful. Ideally, I would love to think that actually helped you in taking a decision of some kind if you want to become an investor, what kind of investor, and why. That was a bit the idea I was having when I started this video, and the idea I will keep having by publishing this video on a regular basis. If you enjoyed it, please click on the like button. That helps me just to spread the news, spread the voice to others who might have an interest. If you want to know when the next video is published, subscribe, costs you nothing. And if you have questions or comments, please do write them down. I will respond to them in my next video, and it will be extremely helpful for me to know what you think about them, what you think about these videos, what you think about the information I'm sharing, if it is useful, if it needs to be changed, if there are certain subjects you are particularly interested in, I will include them in my next videos. So looking forward to get some feedback from you, and looking forward to speak with you again next time for part 3. Goodbye and thank you.